It's a countdown to chaos. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, major companies are on the brink of insolvency, and despite the fact that many believe the U.S. economy is going to experience a soft landing, we're seeing more and more companies head toward insolvency. And I want you to understand why they're headed this way and just how much longer they have before they outright collapse. If you're wondering what we're doing at Goldman Sachs today, well, you're going to be shocked to find out in light of this news today just how they think you should be invested. Plus, we have a sponsor for today's show. Spectre Holdings is back. You can find them on the NASDAQ under the symbol SPEC. And we've noted this is a company to follow based on their news flow and projected earnings, because when you see their charts hit up, it's going to make perfect sense why we think their stock could go up as much as 48%. Check out the pinned comment or description below for more information. Now let's over to Bloomberg, where he picked today's story up. Well, the headline, UK economists say the Bank of England may warn against rate cut bets. Now, I want you to understand the setup here is how we get to this phase of insolvency at a time when many U.S. investors and even foreign investors are piling into U.S. equities because they believe that we're going to see a surge of earnings and a major bull market here. And I want you to understand that a lot of these companies are headed toward insolvency, and how to identify them. You're going to see that the outcome is all about the fact that central bankers, including the ones in the UK, got it wrong. As Governor Andrew Bailey and his colleagues on the 9-member Monetary Policy Committee have highlighted lingering concerns about inflation to support their guidance that rates will need to remain at the highest level in 15 years for the foreseeable future. That is until something breaks in the near term and we see, of course, inflation come crumbling down along with interest rates. And the reason this is occurring is because central bankers, for some unknown reason, believe we're going to see a repeat of the 1970s, where inflation took off, came back down, took off again, came back down, and then went even higher. And that just goes to show how little they understand about the global economy and what really drives inflation. And here you can see, and this is the U.S. data, looking at the Consumer Price Index against total compensation, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That one in red, both on a year-over-year rate of change. And what these experts and political elites do not understand, that if you want inflation, well, you need to have wage growth to drive demand. And when you see periods where wage growth is coming down in form of total compensation, well, eventually inflation follows. So the notion here that we're going to see a resurgence in inflation is highly unlikely from a payroll perspective here. As what we can note is companies, if they don't have price growth in their products, they can't pass on wage growth to their employees. In this case, we're seeing both total compensation and inflation come down. But I want you to understand, these political elites believe that they've got to keep rates higher for much longer, and they have no clue what's about to happen when this insolvency wave begins. And while none of the economists surveyed by Bloomberg last week expected change in the key lending rate on Thursday, the Bank of England is concerned that money markets are pricing in an 80 basis points of easing in 2024. And these bets are loosening financial conditions, reducing the impact of monetary tightening the BOE has delivered. And what I want you to understand is just this goes to show how much they don't understand the global financial system. It's because when rates are going up, that means financial conditions are easing. When they go down, that means they are indeed tightening. That is a problem here. They don't understand it. They've got it completely backwards. In fact, they've got it so backwards, they can't even see what's going on in their own economy. As the euro area to suffer first recession since the pandemic. And so as we know, what happens during recessions is companies can't pay their bills. That's how they start to get into insolvency here. People need to understand this is everything to do with central bankers not understanding how the system works, and it's going to send a lot of companies upside down. And we doubt that we're at the start of an upswing as headwinds remain strong, especially the ones stemming from the massive increase in interest rates. And so we start to get a picture here of what is going to drive this insolvency wave is the fact that there is a record amount of debt out there and it has to be serviced. The problem is at some point, higher rates do actually become an issue. We're getting closer every day. As the weakness is led by Germany, Europeans' largest economy, which is struggling to shake off its manufacturing malaise. As we've noted, they're in a depression. Beset by a budget crisis and weak global demand, the country is expected to experience a 0.2% downturn in the fourth quarter, more than almost doubled than initially projected. Of course, we know it's probably going to get much, much worse after that. But again, this all comes back to what drives insolvency is not just higher interest rates, is when you have a lot of debt, you need the ability to service that debt. And if you're a consumer, well, you generally need a job. If you're a business, well, you need revenues in a big way. But one thing that doesn't happen during a recession is an increase in revenues. As here we can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. This against the general activity index for the Philly Fed manufacturing sector. And what I want to understand here is that even though central bankers have raised rates, they've done above and beyond what the market would have priced rates at. If they would just step back and let the market handle where rates need to be, they would be at a place that works out to not only bring inflation down, but still keep the economy growing. Instead, they drive up the front end of the curve, and this is going to be a big problem for a lot of companies, as you'll soon see. But one thing that's not going to help is, again, decreased demand. Here you can see the manufacturing sector in red going into contraction below the horizontal black line. And that happens every time banks tighten lending standards, which we know is when these political elites invert the yield curves and money curves and keep banks from lending, keep preventing money from being created in a debt-based economy, and it eventually leads to an all-out crisis. And as we know, that what happens during these crises is a lot of insolvencies. And yet Morgan Stanley's Wilson sees big drop in near-term profit views. And so this starts to make sense now why everyone's believing there's going to be this soft landing and huge bull market. What we're starting to see is some experts such as Morgan Stanley come out and say, wait a minute here, perhaps we're not going to see the big profits that everyone's expecting. Because when you start to put this in perspective, if you have inflation coming down and demand coming down, how do you get higher profits? Well, you either get them by cutting your workforce or you find some other mechanisms. But one thing we do know is higher inflation is usually what generates higher profits. And one thing that we do think is headed higher, that is a stock of our sponsor, Spect Air. And here you can see their Air Core product is transforming your perspective with real-time emissions data. And this is a company we've said you want to be watching the news on them. Again, check them out on the NASDAQ under the symbol SPEC. Let's make the case of why their stock can go up as much as 48%. And I want you to see their stock is trading deep in the supply zone here. And the last time it was, well, it shot up and almost doubled in price at one point. And we're making the case it's just going to get up to where the sellers have been at this $2.45 range. And at time of recording, it was trading somewhere right around $1.50 to $1.65. Let's zoom in again here. And you notice on the 30-day, what are you seeing? A lot of accumulation of shares here, and that tells you keep an eye out in any future news flow in this company, because that could be the catalyst that sends their stock surging. Again, check them out on the NASDAQ under symbol SPEC, because the strategists at Morgan Stanley are now highlighting a steep downward revision of consensus fourth quarter estimates. And that adds as he is less optimistic than other strategists about the magnitude of margin expansion next year. We see earnings risk persisting in the near term before the broader recovery takes hold as the next year evolves. And so when you start putting the pieces of the puzzle together, when you have a lot of debt at a company level or even a consumer level, you need income or revenues to cover it. So if you already know that revenues are coming down, well, then you start to put the whole thing into perspective about how insolvencies for many companies are going to increase in a big way. And here you can see again, we come back to the net percentage of banks tightening lending standards for commercial industrial loans to firms of all sizes against corporate profits after tax. Corporate profits shown in red on a year-over-year rate of change. And what I want to note is that as banks tighten lending standards and constrict the creation of credit in our economy, what happens to corporate profits isn't this big surge higher than investors are seeing. What you get is a contraction in them. You see that going into the dot-com bubble, global financial crisis, and you're seeing it now. So it shouldn't be much of a surprise that we see companies go into insolvency. The question is going to become is, why are we going to see a whole lot of them? And again, it comes back to inflation. Well, without inflation, you don't have more revenues. Without more revenues, you have trouble servicing your debt. And here you can see the consumer price index, that's shown in blue, against corporate profits after tax. That one in red on a year-over-year rate of change. And you can note that in periods of high inflation, well, surprise, profits go up because companies have more money, of course, as revenue. And that means better earnings and higher profits. When inflation goes down, well, no surprise, corporate profits decline as well. And yet this puts us in position to see a rate cut pivot. Can't come soon enough for debt-strapped companies as we start to look at this insolvency wave that is coming far sooner than most people think, unless, of course, this means central bankers start massively cutting rates. And well, we know that's not going to happen just yet. The key question is whether inflation readings in coming months will allow policymakers to pivot quickly enough, key words being quickly enough, to blunt the impact of their past tightening to head off a hard landing. Of course, most people don't believe a hard landing is coming, but when you start to see how the debt that these companies are structured, well, that's what's going to be really interesting here, because at a time they experience a slowdown and a decline in earnings, they're going to face a big increase in their debt service costs. The further off the shift, the greater the hit to companies and households from a sweeping repricing of debt as loans and bonds with ultra low interest rates, here we go, expire. And that's the key, and new ones are taken out at much higher cost. That change can't come soon enough for those already feeling the impact, as small U.S. business optimism remains depressed amid elevated interest costs. Multiple Euro region economies are shrinking, and homeowners in countries like Canada, where floating rate mortgages dominate, are slashing spending. So now all of a sudden we talk about some of these monetary lags, and one of them is a point where we see a lot of short-term debt get refinanced at much higher rates. Now you might be thinking is, wait a minute, why didn't these companies take out long-term loans? Well, one of the problems is they never do that. They rely on the fact that rates are going to stay low for a long time, and now they're caught on the wrong side. Any business that has a loan they took out pre-2022 is now going to be facing higher refinancing rates. There's a lot of financial tightening occurring, and thanks to past Fed actions, one reason why we see the economy slowing in 2024, and that I agree with, coming from the chief economist of course, as we know, the U.S. Chamber of Commerce. And companies rated below investment grade are particularly vulnerable, with their debt maturities having shortened remarkably during the rate hike cycle to less than 5 years in the U.S. and less than 4 in the Euro region. So now you have some understanding. If you find a company that's got a lot of below investment grade debt, watch out. They are indeed the ticking time bomb here, because look at this. The maturity of high yield market is the shortest. Get that, shortest it's ever been in my career. This according to Jim Reed at Deutsche Bank, head of global economies and thematic research, saying that, wait a minute, these companies did not prepare for higher interest rates, so they took out not only a lot of short-term debt, they took out mounds of it, and now it's coming due at higher interest rates. Once those higher interest rates hit, those loans get re-locked in. Now they have this higher interest cost at a time when they have less revenue to support it. And you start to see it all makes perfect sense until you listen to what Goldman has to say about how you should be investing. As Goldman says, buy the dip if stocks drop after repricing Fed cuts. And here we see the Deputy Chief Investment Officer of Multi-Asset Solutions advise that any pullback under any premise would be deemed a head fake, with prices moving in one direction before quickly reversing. If the market trades down, it's a good opportunity to rebalance or buy the dip, he said. It's too early to be underweighting the risk premium of equities, but when you start to see all these insolvencies building in the corporate space because of their debt service costs and the slowing economy, the last thing you might want to do is buy the dip. And meanwhile, economists at Goldman expect the Fed to start cutting rates in the second half of 2024 and forecast growth with less inflation, which should be supportive for markets, particularly large cap stocks, which they think you should be buying a whole bunch of. And of course, the narrative here is that the Fed is driving the economy into a wall, and at the last minute, they're just going to do a slight course correction, drop rates just a couple points, and next thing you know, they're going to just avoid catastrophe. And in history, we know that never works. But Goldman's saying, look, that's going to be really bullish for stocks. And yet, it never has. And here you can see the Wilshire 5000 price index against the federal funds effective rate. We can note that going into the dot-com bubble, the Fed cut rates a little bit just to keep the economy humming, and well, then they cut them a whole lot. And that meant stock market came down because when Fed cuts rates, that's bad news for the economy. Here again, they did the same scenario going into the global financial crisis, cut rates a little bit, and the next thing you know, cut rates a whole lot. And they even started that ahead of the pandemic. The stock market didn't react positively until all that pandemic money flushed into consumers' pockets who bought stocks. And now they're telling us, don't worry, the stock market's going to rally if the Fed cuts rates. Well, we'll just say this, that's highly unlikely and historically not accurate at all. But it's not just the U.S. It's not just the Eurozone. Look at this. China's real borrowing costs are surging near highest levels since 2016, meaning these higher rates are starting to bite all over the world. As calculations by Bloomberg adjusted for inflation and relative of the actual cost of borrowings show rates in China have topped 4% and maybe even near 5%, which would be the highest level since 2016. That's in part because consumer and producer prices have fallen at a much faster pace than the country's average loan rate, a figure largely based on changes in the benchmark rate set by the People's Bank of China and major lenders. And so once again, you see what's happening here is that, man, these political elites, these people that are driving monetary policy are not listening to the economy, and they are forcefully putting rates where they think they need to be, not where the market suggests they should be. And that in turn is going to lead to a massive wave of insolvencies. And once these companies refi these higher rates, well, of course, the lenders aren't going to want to drop the rate once rates fall. They're going to want to keep them there, adding pain for many years to come. And China's real interest rates are quite high and still rising. And here we can see that the problem is that high rates mean residents are more inclined to save. That's the narrative here, that if they keep rates higher, people are unlikely to spend. They're turned into savers. The reality is people are looking at the economy. They're seeing it slow down. They're becoming worried about their jobs. And when they do that, they start paying on down on their debt. They start saving money because they know they're at risk from at least a minimum perspective of seeing their hours cut. And that could have a disastrous impact. But all that says is as wage growth comes down, inflation comes down, the ability for companies to service their debt goes down, and then higher interest rates kick in. And next thing you know, you're going to see a huge wave of insolvencies and many companies you never thought it could happen to. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. And keep in mind, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. Bye now.